GETTYThe bloc has a total of €910 billion bad loans, even more compared to financial crisis levels as the European Commission unveiled new plans to tackle the EU debt problem. It emerged the bloc has a total of €910 billion bad loans. Bad loans, when repayments are not made as originally agreed between the borrower and the lender, which may never be repaid, have piled up as an after-effect of the financial crisis. Bad loans also make it harder for EU banks to issue new loans, and as a prevalent issue the EU Commission wants to deal with. The European Commission wants banks to be able to get rid of bad loans more easily and is considering adopting a new system which would prevent banks from being able to accumulate bad loans. Friday, October 20, 2017, Emmanuel Macron holds a press conference on the second day of European Council meetings. Valdis Dombrovskis, EU Commissioner for Finance, on Wednesday said, "Prevention is the best remedy." The €910 billion represents 4.4% of all loans issued in Europe, and the amount of bad loans in each EU state greatly differs. The country with the highest level of bad loans issued is Greece, who has 46.7% of loans issued becoming bad loans. Greece is followed by Cyprus, Portugal, and Italy. Germany only sees 2.1% of loans becoming bad loans. The EU Commission is also worried that banks are finding it hard to issue new loans due to the bad loans surmounting, believing these loans present the biggest risk to the European banking system. Wedne, a German MEP, said, "The mountain of bad loans is still higher than before the last financial crisis. The institutions have to prepare themselves in the current upswing for the next downturn." The Commission wants to strengthen secondary markets in order to provide a fail-safe for bad loans, as this would allow banks to sell their bad loans to investors or credit service providers. The secondary market is a financial market in which previously issued financial instruments such as stock, bonds, options, and futures are bought and sold. This would mean that if repayments cannot be made, then financial institutions will be able to recover the collateral involved in a bad loan almost immediately from companies, without any legal action. GETTYThe bad loans are unevenly spread out across the EU. The Commission also wishes to allocate additional equity in the future to cover the risks that come with default-prone loans. Also, the Commission is handing out framework and rules for bad banks. Bad banks take on and manage bad loans. Mr. Dombrovskis said, "Now that Europe and the European economy are on the upswing, the EU needs to leverage the momentum and accelerate the reduction of bad loans. With less bad credit on their balance sheets, banks can lend more to households and businesses." There have been proposals to start joint savings system. However, one of the main players of the EU, Germany, is not a fan of this idea. The German federal government has said that the huge risks in the European banking sector must be reduced before they can start sharing the burden of this financial problem. Markus Ferber, a German MEP, said, "The Commission's proposals point in the right direction. The risk-taking rate is still in the double-digit range in many member states. This majorly slows down lending and economic development. The southern states in particular must finally do something." Additional reporting by Monica Pallenberg.